In this video we are going to talk about call options. So before starting, please like this video and subscribe to this channel for our future updates. What is a call option? Options on stocks, bonds, commodities, and other assets or instruments are financial contracts that provide the option buyer the right but not the responsibility to purchase the underlying asset or instrument at a given price within a specified time period. The stock, bond, or commodity that serves as the underlying asset is referred to as the underlying asset. It is profitable for a call buyer if the price of the underlying asset increases. A call option, as contrast to a put option, grants the holder the right to sell the underlying asset at a stated price on or before the expiration date of the call option contract. Understanding call options. Assume the underlying asset is a share of stock. The holder of a call option has the option to purchase 100 shares of a firm at a given price, known as the strike price, until a specific date, known as the expiration date. A single call option contract, for example, would provide the holder the right to buy 100 shares of Apple stock for $100 until the contract expires in 3 months. Traders can choose from a variety of expiration dates and strike prices. The price of the option contract rises when the value of Apple stock rises, and vice versa. The call option buyer can keep the contract until it expires, at which point they can either take delivery of the 100 shares of stock or sell the options contract at any time before the expiration date for the current market price. You must pay a premium in order to purchase a call option. It is the price paid for the rights provided by the call option. The call buyer loses the premium paid if the underlying asset is below the strike price at expiration. This is the largest amount of money lost. If the current market price of the underlying asset is higher than the strike price at expiry, the profit equals the difference in prices less the premium. This amount is then multiplied by the number of shares held by the option buyer. If Apple is trading at $110 at expiry, the strike price of the option contract is $100, and the buyer paid $2 per share for the options. The profit is $110. $100 plus $2 equals $8. If the buyer purchased one options contract, their profit is $800, $8 by 100 shares. If they purchase two contracts, their profit is $1,600, $8 by 200. Now, if Apple is trading below $100 at expiry, the buyer will certainly not exercise the option to acquire the shares at $100 per share, and the option will expire worthless. For each contract purchased, the buyer loses $2 per share, or $200, but that's it. That's the allure of choices. If you don't pay the premium, you won't be charged. Purposes of call options. When it comes to call options, they're typically used for three main reasons: revenue generating, speculation, and tax management. Making use of income-generating options. Call options are used by some investors to earn money through the use of a covered call strategy. It is possible to profit from this technique by purchasing an underlying stock while simultaneously writing a call option, which is effectively granting someone else the right to purchase your shares. The investor receives the option premium and expects that the option will become worthless before it expires, below strike price. However, if the underlying stock price rises significantly, this method can limit the amount of profit the investor can make. Because if the stock climbs over the strike price, the option buyer will exercise their right to purchase the stock at the lower strike price. Covered calls are effective. This means that if the stock rises above the strike price, the option writer will not profit from the move. The premium earned by the options writer represents the maximum profit that can be made on the option. Using options for speculation. Customers can gain large exposure to a stock at a relatively low cost by purchasing options contracts on the stock. When used alone, they can result in huge gains if a stock's price increases. However, they can also result in a complete loss of the premium if the call option expires worthless as a result of the underlying stock price failing to rise above the strike price at which the option was purchased. The advantage of purchasing call options is that the risk is always limited to the amount of money paid for the option. In addition, investors can purchase and sell different call options at the same time, resulting in a call spread. These will cap both the potential profit and loss from the strategy, but they are more cost-effective in some cases than a single call option, because the premium collected from the sale of one option offsets the premium paid for the other option, which is more cost-effective in some cases than a single call option. Using options for tax management. It's possible for investors to adjust their portfolio allocations without actually buying or selling the underlying security when they employ options. For example, if an individual owns 100 shares of XYZ stock, He or she may be liable for a significant unrealized capital gain on the investment. Shareholders who do not wish to trigger a taxable event may use options to minimize their exposure to the underlying investment without actually selling it to reduce their tax liability. While gains from call and put options are similarly taxable, the IRS treats them in a more complicated manner due to the large number of different types and variants of options available. When using the technique described above, the shareholder incurs solely the cost of the options contract itself as a result of his or her decision. Real-world example of a call option. For example, assume that Microsoft shares are currently trading at $108 a share. You hold 100 shares of the stock and wish to produce additional revenue in addition to the dividend paid by the stock. Your second point of view is that stock prices are unlikely to grow above $115 per share in the coming month. You take a look at the call options for the following month and see that there is a 115.00 call option that is trading at 37 cents per contract for the following month. For example, suppose you sell one call option and receive $37 in premium, 37 cents by 100 shares, which represents an annualized income of approximately 4%. The option buyer will exercise the option if the stock price climbs above $115. In such case, you will be required to deliver the 100 shares of stock at $115 per share. You still made a profit of $7 per share, but you will have missed out on any potential gains above $115 in the stock market. If the price doesn't increase above $115, you keep the shares as well as the $37 in premium revenue from the transaction. How do call options work? Call options are a type of derivative contract that gives the holder the right, but not the obligation, to purchase a specified number of shares at a predetermined price, known as the strike price of the option. If the market price of the stock rises above the option's strike price, the option holder can exercise their option, buying at the strike price and selling at the higher market price in order to lock in a profit. Options only last for a limited period of time, however. If the market price does not rise above the strike price during that period, the options expire worthless. Why would you buy a call option? Investing in call options is an option that investors will consider if they are positive about the prospects of the underlying stock, also known as bullish. Because of the leverage that call options give, they may be a more appealing tool for these investors to bet on a company's prospects. Indeed, each option contract provides the possibility to purchase 100 shares of the corporation that has issued the contract. For an investor who is confident in the future performance of a company's stock, purchasing shares indirectly through call options can be a lucrative approach to improve their purchasing power and reduce risk. Is buying a call bullish or bearish? Buying calls is a bullish strategy since the buyer only makes money if the stock price rises. Selling call options, on the other hand, is a bearish strategy because the seller wins if the stock does not rise. While a call buyer's profits are potentially boundless, a call seller's profits are restricted to the premium they receive when selling the calls. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.